Thank you for listening to the Council of Institutional Investors Voice of Corporate Governance, the #1 corporate governance podcast in the U.S. for 2025 as determined by Million Podcasts. I'm your host, Jeff Mahoney, General Counsel of CII. The purpose of these monthly episodes is to update CII members and the general public on significant developments in corporate governance and capital markets regulation and CII's related advocacy activities. This update covers a period from March 26th to April 30th, 2026. The following is my top 10 list of events over that period. Number 10, on April 15th, as a follow-up to President Trump's December executive order entitled Protecting American Investors from Foreign-Owned and Politically Motivated Proxy Advisors, the U.S. Department of Labor's Employee Benefits Security Administration issued a news release announcing the issuance of new guidance targeting retirement plan proxy voting and proxy voting retirement services. The new guidance indicates that proxy advisory firms commonly engage in business practices that meet the test for being investment advice fiduciaries. The executive order directed the Secretary of Labor to strengthen Employment Retirement Income Security Act fiduciary duty rules and increase the transparency around the use of proxy advisors. The department says proxy advisors regularly engage in conduct that makes them investment advice fiduciaries under the Department of Labor's 5-part test dating back to 1975. Under that test, a person is a fiduciary only if they meet the following 5 tests. 1, they render advice as to the value of securities or other property or make recommendations as to the advisability of investing in, purchasing, or selling securities or other property. 2, on a regular basis. 3, pursuant to a mutual agreement, arrangement, or understanding with the plan or a plan fiduciary that. 4, the advice will serve as a primary basis for investment decisions with respect to plan assets. And 5, that the advice will be individualized based on the particular needs of the plan. The guidance adds that proxy advisors fit the definition of functional fiduciaries under the Employment Retirement Income Security Act. Under the Employment Retirement Income Security Act, fiduciaries must meet strict standards of prudence and loyalty to plan participants while seeking to maximize risk-adjusted financial returns. In addition to proxy advisors, the guidance questions if the actions of others, such as large asset managers, sovereign wealth funds, and the overseers of proxy plumbing, render them investment advice fiduciaries as well. In addition to proxy advisors, the guidance questions if the actions of others, such as large asset managers, sovereign wealth funds, and the overseers of proxy plumbing, lead those entities to also be categorized as investment advice fiduciaries. Number 9, on April 21st, the U.S. House Financial Services Committee in a 27-24 vote passed H.R. 8286, which was introduced by Representative Brian Stile of Wisconsin and takes aim at proxy advisors. The Protecting Americans' Retirement Savings from Politics Act is a compilation of 10 bills that were included as part of an April 29th Subcommittee on Capital Markets hearing entitled Exposing the Proxy Advisory Cartel, How ISS and Glass Lewis Influence Markets, and a September 10th full committee hearing entitled Proxy Power and Proposal Abuse, Reforming Rule 14A8 to Protect Shareholder Value. The omnibus bill would include the following 10 requirements. 1, when the U.S. Securities Exchange Commission is engaged in rulemaking mandating corporate disclosure, the Commission will specify that companies are only required to disclose information to the extent that the companies have determined that such information is material with respect to voting or investment decisions. 2, establishment of an SEC Public Company Advisory Committee to advise the Commission on rules, regulations, and policies. 3, the SEC is required to conduct a study of the effect of the European Union's Corporate Sustainability Due Diligence Directive and Corporate Sustainability Reporting Directive on U.S. companies, consumers, and investors. 4, the SEC would be required to conduct a study no later than 180 days after legislation is enacted and every 5 years thereafter on proxy advisor firms and the proxy process. 5, proxy advisors would be required to submit a detailed registration to the SEC, which the Commission can approve or deny. 6, proxy advisors would be subject to liability for failing to disclose material information or making material misstatements regarding proxy voting advice. 7, investment advisors, asset managers, and pension funds that use proxy advisors would be required to file an annual report with the SEC containing an explanation of how they voted with respect to each shareholder proposal, the percentage of votes cast on shareholder proposals that were consistent with proxy advisory firm recommendations, how such votes are reconciled with the fiduciary duty of the institutional investment manager to vote in the best economic interests of shareholders, and the degree to which investment professionals of the institutional investment manager were involved in proxy voting decisions. 8, the SEC would be required to issue rules prohibiting investors from voting in a manner consistent with the recommendations of a proxy advisor firm without independent review and analysis. 9, passively managed funds would be required to vote in accordance with the instructions of the beneficial owner, vote in accordance with the voting recommendations of the board of directors, abstain from voting such securities, or instruct vote tabulators to mirror vote shares to reflect the elections of the other shareholders in the covered security. And 10, the SEC be required to implement rules mandating that investment advisors use pecuniary factors when determining the best interests of their customers, unless those customers provide informed consent, whether by e-delivery or e-signature, that such non-pecuniary factors be considered, or the personalized investment advice is consistent with the customer's written investment profile information. Democratic members of the committee introduced 5 amendments related to diversity, equity, inclusion, climate change, human capital management, and shareholder proposals. None of those amendments were approved by the committee. During the committee markup, Representative Sean Casten of Illinois commented, this legislation would rewrite the definition of materiality to allow companies, not company owners, to decide what information is material and what is worth disclosing to investors. Representative Casten asked his fellow committee members, how did it become so partisan to say that Milton Friedman was right when he said the purpose of a company is to look out for the interests of its shareholders, not their C-suite, not those who donate to politicians on Capitol Hill. A vote on the House floor for the legislation has not yet been scheduled. Observers believe the likelihood of the legislation as currently written passing the U.S. Senate before the end of this Congress is slim to none. Number 8, in an April 21st speech before the Economic Club of Washington, U.S. Securities and Exchange Commission Chair Paul Atkins discussed his regulatory plans. As part of his agenda to make IPOs great again, Chair Atkins said he has instructed Commission staff to examine the following 4 areas. 1, adopting a regulatory IPO on-ramp that supplements the concept that Congress described in the Jobs Act. 2, expanding the existing accommodations that are currently available only for emerging and smaller companies to more companies. 3, providing nearly all companies with an easier path to shelf registration, which allows them to access the public markets quickly when market conditions are ideal. And 4, giving companies the option of a quarterly or semi-annual regulatory filing cadence. Chair Atkins said that by rejecting the institutional drift that the previous administration has normalized, I am pleased to report that we are recalibrating the agency in line with its statutory mission. An aggressive rulemaking agenda in the coming year, meanwhile, will build on the work that we have begun at an auspicious moment, he added. Number 7. On April 22nd, the State of California Senate Committee on Labor, Public Employment, and Retirement passed a bill requiring state pension funds to beef up their disclosure about investments in private equity. The Private Equity Sunshine Act requires California pension funds to report on how well their private equity and private debt investments perform against public market benchmarks. The bill was authorized by Senators Dave Cortez of San Jose, Maria Ella DeRosa of Los Angeles, and is reportedly backed by State Treasurer Fiona Ma and the California Federation of Labor Unions. Reported some union funds, which strongly support the bill, say it will provide greater transparency by requiring private equity firms that do business with California public pension funds to report their assets' identity, location, and number of workers employed at those companies. That information could enable labor groups to identify non-unionized workforces and monitor those firms for their treatment of workers and exposure to investment risks. Those opposing the legislation argue that the private equity industry benefits from having hidden investment strategies. Opponents also argue that requiring disclosure of detailed information could push the top-performing private equity firms to do business with pension funds that have less onerous reporting requirements. Number 6. On April 30th, the Public Company Accounting Oversight Board's Office of Investor Advocate issued an alert. The alert states that the Public Company Accounting Oversight Board Investor Advisory Group is requesting critical audit matters or key audit matters for its analysis. As explained by the Investor Advisory Group during its April 26th meeting, the Investor Advisory Group is seeking nominations from the general public, including from public company issuers, auditors, financial analysts, investors, for the most decision-useful critical audit matter or key audit matter contained in public company audit reports included in the 2025 Form 10Fs and Form 20Fs. All timely nominations received will be reviewed and evaluated by the Investor Advisory Group. The Investor Advisory Group will select what they believe to be the top 3 decision-useful critical audit matters or key audit matters for 2025 among those nominated. Those critical audit matters or key audit matters selected will be identified and discussed in an IHG report expected to be issued publicly later this year. Each nomination, which may be submitted anonymously, should include an explanation of a maximum of 500 words or less of why the nominated critical audit matter or key audit matter provides decision-useful information to investors. Investor Advisory Group has requested that the public provide submissions to the Investor Advisory Group by a deadline of June 30th, 2026. All submissions should be sent via email to jeff@cii.org. That's jeff@cii.org. Number 5. On April 15th, a federal judge in the U.S. District Court for the District of Columbia rejected the Mission Fund's request for a preliminary injunction to compel UnitedHealth to include on its proxy ballot a proposal filed by the fund. The proposal asks the company's board to publish a report describing the healthcare consequences of its acquisitions over the past 10 years. The fund asserts that in recent years, UnitedHealth Group has pursued a strategy of vertical integration, acquiring companies in parts of the healthcare value chain other than insurance. This integration creates risks for the healthcare system, including by reducing patient choice and access to care, potentially impairing patient care, and creating perverse pricing incentives among UnitedHealth Group's subsidiaries. The company argued that the proposal could be amended under the ordinary business rule. The SEC, under its new approach to no action decisions, concurred. The ruling said Mission Fund has not made a clear showing that it is likely to succeed in establishing that its proposal lies beyond the scope of the ordinary business exclusion. The company also had asked the court to dismiss the case, but it declined to do so, saying UnitedHealth Group remains free to move to dismiss Mission Fund's complaint as it represents that it initially intended to do. By contrast, on April 22nd, U.S. District Court for the District of Massachusetts granted New York State Comptroller Thomas DiNapoli injunctive relief. The judgment ruled that BJ's Whole Club Holdings argument that the comptroller's proposal could be omitted because it pertained to the company's ordinary business was not valid. The proposal asks BJ's to conduct an assessment of the risk of deforestation associated with its private label brands within 1 year and provide a report summarizing the results. The reporting statement notes that BJ's peers disclose deforestation risk assessment results across their supply chains. The reporting statement adds that BJ's lack of comparable assessment and commitment to eliminate deforestation lags peers and limits the company's ability to manage supply chain risks, mitigate reputational and operational vulnerabilities, and safeguard long-term performance. The ruling said the proposal did not pertain to the company's ordinary business because it focused on the company's private level brands and deforestation rises to the level of a significant public policy issue transcending ordinary business. The court also refused BJ's request to dismiss the case. As part of the ruling, the comptroller is required to pay BJ's $20,000, which is the estimated cost to add the proposal to BJ's proxy before it is mailed. Number 4, on April 23rd, the staff of the Council of Institutional Investors released a dashboard tracking every Rule 14a8 no action notification filed with the U.S. Securities and Exchange Commission and posted on their website. Dashboard, which can be accessed from CII's website at www.cii.org, includes the following 3 features. 1, it updates automatically every morning. 2, it covers the full 2025 proxy season. 3, it includes, as of the date of this podcast, 191 notifications. For each notification, the dashboard provides the following 8 pieces of information. Number 1, the proposal. 2, the parties involved. 3, the company's exclusion argument. 4, legal grounds and vote. 5, precedent cited. 6, timeline. 7, related litigation or events. And 8, the outcome. Number 3, on April 2nd, the staff of the Council of Institutional Investors released an analysis of newly updated CII members' publicly available proxy voting and stewardship resources. The analysis finds U.S. asset managers and European managers moving in sharply different directions. These updates include changes on the following 3 topics. 1, some members have continued to replace references to diversity, the environment, social issues, and other topics with broader language about human capital management, qualifications, and general alignment with board and management recommendations. 2, some members also have placed greater emphasis on the financial materiality of their stewardship priorities. 3, some members have not updated their stewardship or sustainability reports in several years while continuing to update their proxy voting guidelines and other core governance resources. Among major institutional investors that revised their proxy voting guidelines this cycle, CalPERS is the only one that added instead of eliminated information. Its 2026 proxy voting guidelines expand scrutiny of executive compensation and state that director nominees may receive no votes if there is evidence of insufficient oversight of AI-related risks. Many of those revisions come in the aftermath of the U.S. Securities and Exchange Commission's guidance last year on how institutional investors can engage with companies, as covered earlier in CII's governance alert. The previous cycle of guideline updates saw a renewed focus on core governance issues, as well as less prescriptive positions on environmental and social issues. Some investors also removed stewardship materials from their websites or made them less prominent. Number 2, on April 30th, the CII Research and Education Fund published a new resource offering a high-level comparison of jurisdictional approaches among Delaware, Nevada, Texas, and the Cayman Islands. The table summarizes critical corporate governance, shareholder rights differences, such as director and officer liability, fiduciary duties, and shareholder litigation rights, highlighting how specific features impact corporate oversight and investor protections. And my number 1 most significant development in U.S. corporate governance and capital markets regulation for the period from March 26th to April 30th occurred on April 2nd, when the Council of Institutional Investors submitted a comment letter to the U.S. Securities and Exchange Commission offering recommendations for the Commission's planned reforms to Regulation SK disclosures. Overall, CII supports disclosure of material information that a reasonable investor would consider important in making investment or voting decisions. Furthermore, the letter advises the SEC not to prioritize reducing the volume of Regulation SK disclosures. The letter says that, in our view, improving company disclosure effectiveness is less about changing what is currently disclosed and more about improving how information is communicated. Along those lines, CII recommends the Commission consider how advances in artificial intelligence and technology generally are impacting the cost and time required in both the preparation and the use of company disclosures. More specifically, the letter supports requiring companies disclose the following 4 items. 1, the total cost of the workforce, as well as information about the numbers of full-time, part-time, and contingent workers and employee turnover rates. 2, a plain English narrative of the reasons for a change in external auditors in all cases. 3, no reductions in the existing information currently required to be disclosed to enable shareholders to hold the board accountable for safeguarding the company's cybersecurity threats, and 4, no reductions in the existing information recently required as to whether a company has adopted insider trading policies and procedures that are reasonably designed to promote compliance with insider trading laws, rules, and regulations, and any applicable listing standards. CII's letter also recommends that the SEC require companies with multiple share classes with unequal voting rights to supplement their Form 8K final voting results with tallies for each class. Currently, SEC rules require companies to disclose only aggregate vote tallies for each proposal and whether each proposal passed or failed. The letter says that, quote, this level of transparency does not convey the degree to which high vote shareholders at multi-class companies may be vetoing the preferences of the holders of a majority of the company's equity. That completes my monthly update on significant developments in corporate governance, capital markets regulation. If you have any questions regarding any of the issues discussed, please feel free to email me at Jeff, that's Jeff, at CII.org. Until next time, I'm Jeff Mahoney. Thanks again for listening to the Voice of Corporate Governance.
Thank you for listening to this episode of The Voice of Corporate Governance, brought to you by the Council of Institutional Investors. The Voice of Corporate Governance is a free, non-sponsored podcast that highlights critical developments in corporate governance and other important issues affecting institutional investors. The views expressed by those interviewed on the podcast do not necessarily reflect the views of CII or its members. For more information on CII and its policies on corporate governance, please visit our website at www.cii.org.